Hello everyone and welcome to the Betashares Economic and Investment Outlook 2023. Has the RBA finished hiking rates? With David Bassanese and myself, Chris Yates. Just before we get started, as always, just have a quick read of the slide and obviously indicating and pointing out that past performance is not indicative of future performance, and anything covered today is very much general advice and doesn't take into account anyone's personal circumstances. The webinar will be recorded, so if you do miss anything or want to go back over any of the slides or the content covered today, this will be sent out tomorrow for you, so you'll be able to go back then. And there will be time at the end for questions. So as David goes through these key topics today, please write through your questions and we'll make sure that we can try and get through as many of those as possible. To keep on top of all the regular content, fund information, the best place and source of truth is going on our website there. And also to keep on top of markets and the economy, David has his regular newsletter, Bassanese Bites, that comes out on a Monday. So if you jump on the website, you can just subscribe to that under the Insights page. And keeping across everything that's happening in Betashares with fund launches, you can follow us on our social media channels there. Quick update on Betashares. Betashares now, we're actually just over $26 billion, but yes, fast growth. And again, thank you for everyone that's attending this webinar today, who's taken the time to review and select our funds over the year. We have 79 different ETFs available on the ASX for investors to use, 130 colleagues across Australia, across 5 offices, and now over 800,000 Australian investors using our funds. So again, thank you for that long-term and continued support. David Bassanese, our Chief Economist here at Betashares, he is responsible for developing economic insights and portfolio construction strategies. He sits as the chair of our investment committee for our managed account portfolios and is very well credentialed as economist at the Australian Financial Review, senior economist and interest rate strategist at Bankers Trust and Macquarie Bank, Treasury and OECD economist, and also has written a book. And if you want to learn more about how to build portfolios using ETFs, that's a great resource to go through that book. In terms of today, the agenda is just the economic situation. They will be covering that, having a look at some policy response and outlook, and also what is the implications of those policy responses and outlook in terms of the investment implications as well. So David, with no further ado, I'll jump back at the end for the questions, but I'll pass over to you.
Thanks very much, Chris, and great to be with you all for our second quarterly economic update. Those of you may have been here for what we called a flash update just a few weeks ago on the back of the banking instability that we saw. So it's a bit of so we are doing a follow-up, relatively quickly, but this is probably a broader, more encompassing sort of overview, focusing not just on the banking issues, but broader economy. So yeah, great to be with you all. Obviously, thrills and spills continue in the markets, and so I'll go through some of that at the moment, and what are some of the risks and opportunities out there over the months ahead. First, in terms of economic situation, just a snapshot here of key global market trends. US market, US dollar, 10-year bond, and broadly speaking, I mean, the theme of recent months has been, we had the sell-off in equity markets last year on the back of very aggressive interest rate increases by central banks, who were finally worried about high and persistent inflation, and they decided to, dampen down on that. We have seen that inflation globally has broadly sort of peaked. In the US, it's starting to come down, although it's still high, uncomfortably high and sticky in some parts, but it's sort of coming down. And at the same time, the US economy is not yet in recession. It's actually still punching out reasonably good employment growth. And so markets, as you can see, basically have bottomed late last year, late October. So the equity market in the US has had a bit of a recovery. Obviously hasn't gone back to its highs, but it's had a bit of a recovery at the same time as bond yields, longer term bond yields have broadly peaked. They did touch above 4% at one point, have come back down, and the US dollar is also weakened. So markets are still hoping or trading, well, the equity market at least is trading on the hope of a soft landing. You may have heard me talk about this in the past, the idea that inflation is going to come down, and so far at least the economy is not in recession, so the Fed can potentially stop raising interest rates, the US central bank, and potentially even cut rates in the second half of the year, which is what the bond market is pricing in at the moment. So that is the state of play globally. You can see oil prices have come off as well, which is helpful in terms of getting inflation down. So markets are trading on the hope of a soft landing. Equity markets, that's why they're still up there, and the bond market is pricing in rate cuts by the US Federal Reserve in the second half of the year. Not exactly sure. I mean, two reasons for that. It could be that they, expect a recession. The bond people are expecting a recession, or that they expect not a recession, but a very quick drop in inflation, such that even though the economy isn't in recession, the Fed might still cut interest rates. But that is the state of play. In terms of the Australian market, you can see we also have had a bit of a recovery in our equity market. It's been a very choppy sideways range, broadly speaking, over the past year or so. Trapped between this 6,500, well, just in the last few, since late last year, trapped in this 7,000 to 7,500 range for the ASX. You can see the Aussie dollar has tended to weaken despite the weakness of the US dollar. And 10-year bond yields, as we've seen in the US, have sort of come off. The sell-off that we saw through most of last year has moved into a more of a sideways range, and if anything, they're threatening to break to the downside. Iron ore prices also coming off over recent weeks. Global equity trends, you can see here, Australia, focus on the lower left side. Australia, look, it did outperform in the early stages of the sell-off in equity markets through last year. Financials and resources tended to do well. The technology sector didn't do well globally with rising interest rates. And so you see the US market broadly underperformed. Our market outperformed. You can see that growth versus value parts of the market underperformed. But with this soft landing hope that markets have been toying with since late last year, we've seen a bit of a rotation back toward growth, back toward technology, back toward the US market, and out of the Australian market because of the, we tend to have an underweight to technology. Our economy, look, still showing pretty good resilience. The unemployment rate running at 3.5%. Growth has slowed, GDP growth, but still far from any concern about negative economic growth. Inflation looks like it's peaked. We've had some encouraging news on the inflation front lately. A bit like in the US or globally, I mean, inflation is still too high. There are areas where it's sticky, which I'll touch on in a moment, but at least it's stopped rising. You can see also house prices of late have bottomed. The Core Logic, that's a measure from the Core Logic monthly house price index. So nationally, if the bottom happened back in March, it was about almost a 10% national decline in house prices over the past year. We've had about a 1.5% bounce back already just in the last couple of months, which I think is one of the reasons that the RBA did decide to raise rates a couple of weeks ago, out of concern that we could already be creating animal spirits in the housing market a little bit too quickly. They do want the housing market to remain relatively weak for a while because they want to help slow consumer spending, which is part of helping to ensure that inflation comes down. So that's the snapshot of the Australian economy at the moment. You can see their house prices bottoming at the moment. Again, there is a risk of a double dip in house prices if the RBA does raise rates again. I'll touch on the risks there soon. And or the unemployment, the economy does slow and the unemployment rate edges higher, as I expect eventually over the course of the coming year, that you may get a bit of a dip down in house prices as well. It also remains the case that mortgage affordability in Australia is still very, very poor. I mean, I put out some analysis, got a bit of media coverage a few weeks ago. It takes, it's as difficult to pay a mortgage now for a medium-priced home as it was back in the 1990s when mortgage rates around about 16%. Because house prices relative to income have gone up. So even if the RBA doesn't raise rates again, it's just hard to think that we're going to get a surge back in house prices given the affordability constraints that we've already got. And you can see there the trends by state. So the markets that have had the bigger declines across the east coast, Sydney, Melbourne, Brisbane, some of the smaller cities haven't had quite the decline that we've seen in those bigger markets. And as a result, we've had a bit of more of a bounce back in those markets, particularly Sydney, in the last couple of months. So just in terms of Australia, this is still the ongoing challenge for us. This is some updated charts from the RBA statement of policy that came out last week. You can see that inflation is high. At the annual rate is still, north of 6%, but it's come down. And you can see there's a broad, and it's across a number of areas. So there's a number of points to say. Inflation has peaked. It's still too high. And the range, and it's broadly based. You're seeing it across goods and services, as you can see also from the number of items across the CPI that are right there, where the annual rate is above 3%. Couple of quarters ago, it was like 8 out of 10 items had an annual rate of 3%. That's now come down to 6 out of 10, but nonetheless, still pretty broad based. And what we are seeing is that the decline in inflation so far in Australia is being led by the goods side of the goods sector. We've had a lot of so-called supply chain bottlenecks globally, the disruption to production during COVID, the shortages of many goods that led to goods prices going higher have been resolved, and we're starting to see, things like furnishings, household appliances, even clothing and footwear, which are usually pretty flat. You can see the environment prior to the pandemic. Goods prices generally are pretty flat, but then they did surge over 21, 22, but now they are starting to come back down again. We are left with services inflation, though, which is still basically offsetting that, partly offsetting the decline in goods inflation we're seeing at the moment. And globally, this is, the ongoing issue is that, yes, goods prices are coming off, but service inflation, particularly given very tight labour markets, given the rebound in and still some degree of pent-up demand for services in areas like travel, for example, leading to ongoing pricing pressures there. So the inflation challenge is certainly has not been removed. It's still ongoing, and that's why central banks globally, I think, do retain a tightening bias. If anything, over the next few months, rates are likely to go higher than be cut, simply because of that pesky service sector inflation that we're still dealing with. And this is why central banks are responding. These are a couple of measures of short run and longer run measures of inflation expectations. And then you can see that in the short run, various surveys across Australia have shown that consumers, market economists, even the financial markets have do anticipate high inflation in the short run. But at the moment, various measures of longer run inflation expectations have still remained relatively contained, which is on the second slide there, apart from surveys of unions, which has picked up. But if you look at various other surveys, longer term inflation expectations as defined by the RBA, according to all these measures at the moment, is still relatively contained, which is good news. We don't want to see those pick up. But this is why the RBA ultimately can't wait forever for inflation to come down, because the longer we wait, the longer it stays high, the greater the risk that it feeds through to long-run inflation expectations and then gets embedded into the system through wage price spirals, as we term. So that's why at the moment the RBA, is being somewhat patient. It's not driving the economy into recession yet. It does have an expectation that the economy will slow, wage inflation will moderate, service inflation will moderate, and it's got inflation coming back to the band over the next couple of years. Well, actually, I'm probably getting ahead of myself there, but and provided that remains the case, then they can be a little bit more forgiving of the economy at the moment. Now, and just on that, so inflation coming off, still sticky. If longer term inflation expectations still contained, that's important. If those numbers there did start to pick up in a major way, the RBA would then be more aggressive in terms of wanting to raise rates. So at the moment, again, as long as those long run inflation expectations are contained, it's an argument in favour of the RBA not needing to do a lot more. Another argument in that sense is that we are seeing an easing of labour demand. So employment intentions from business surveys, you can see there on the right-hand side, have come off, still high. Job advertisements also coming off somewhat. Again, still high, but at least starting to ease somewhat. The other more mixed factor for the economy is population growth. And you can see there a big rebound in immigration over recent months, so through the course of last year and into this year, which is going to add to demand. It's going to add to retail spending, add to housing demand, but at the same time, it will probably help redress some of the labour shortages that we're seeing as well. So it has mixed implications for interest rates, really. But I think it will reduce the risk of an outright negative period of economic growth, given that population growth is, at least for the next couple of years, could be running at 2%, and it could potentially dampen some of the possible further wage pressures we might get given labour shortages. The other area, and importantly here, home building approvals are coming off. There is a backlog of work still being worked through in the housing sector. So housing construction is still at a high level, but the new approvals have weakened, and so progressively home building activity should also weaken over the course of the coming year. And probably most importantly is that consumer spending, which is 60% of GDP, has started to slow over the last couple of quarters as well. It was pretty soft in Q4, and the early indications are that it was pretty soft in Q1 as well. We know that retail sales volumes, although retail sales themselves have a big goods component, so some of the softness in retail sales is actually part of the shift from goods back into services, but overall retail sales volumes were flat in Q1. So unless there was a massive rebound in service consumption, which we won't know about till we get the Q1 GDP, it's likely that overall consumer spending remain pretty soft in Q1. So again, giving the RBA some heart that the rate rises that it's done to date is starting to moderate growth, which is what it wants to see. Just on that, I mean, actually, before I'll talk about the RBA in a minute. Obviously, we just had the federal budget. And I thought this was, again, probably in the interest of time, I won't go through this in detail, but this is the sort of table that economists like myself go to when we look at the budget, the first thing. And you can see that so basically the bottom line of the budget is it is net expansionary. I mean, you can see there is a small surplus this year, 4.2 billion. So they ended up, because of the economy and commodity prices have been somewhat more resilient than expected, stronger than expected, the government got a lot more receipts, something like 28 billion in extra revenue than expected back in October. Most of that has flowed through to the budget, such that instead of expecting a deficit of 36 billion, it's actually looking at a surplus of a small surplus of 4.2 billion. But importantly, it shifts back into deficit next year to 13 billion. So that's a deficit of about 0.5% of GDP, driven by extra spending of around about $12 billion, as you can see here. And a lot of this is in worthy causes, increasing the New Start allowance, rental assistance, a whole bunch of social welfare spending, which is very, from a social point of view, wouldn't argue against. The only problem is from a macroeconomic point of view, there hasn't been offset by a lot of tax increases or spending cuts elsewhere. So net effect is that the budget is moderately expansionary, and as a result, doesn't help in slowing the economy, doesn't make the RBA's job any easier, and on balance probably makes it a little bit harder. But that's, I guess, all I want to really say about the budget. And in fact, you can see the budget goes into further deficit in 24-25 to another, blows out to 1.3% of GDP. So the change over 2 years is about 1.5% of GDP. So it's, that's why I've argued that this is an expansionary budget, and will actually add to demand rather than, help slow demand. And these are just some projections of the budget deficit. You can see the small surplus here, and then we get the budget going back into deficit. Obviously, these are the projections that we had back in October. So the budget bottom line is better than we thought back in October, certainly better than expected, but that's because the economy has been stronger than expected. But anyway, that's the budget. And you can see there, based on the projections, the budget's not expected to get back to balance again until the end of until the early 2030s. So it's still quite a challenge ahead in terms of getting the budget deficit under control. Just some quick comments on what are all these numbers. I thought this is interesting. I haven't shown this before, but what this is the difference in global equity market performance versus Australia. So I've got the 12-month or the 52-week performance, and then the six-month performance. And what you do is you can break it up by sector, and you can see here. So over the past 12 months, the Australian market has returned 5%. The global market has returned 3.7%. So we've outperformed by a little bit. And in the past 6 months, we've underperformed. But you can break it down into what has been driving that, and it's basically three areas. So financials, technology, and materials. So if you look at financials, we've actually underperformed the performance of the financial sector globally. It may surprise some, but the global banks have actually done a little bit better than the Australian banks over the past year, and that's been a drag on performance. Offset, and the other drag on performance is the fact that so that's been the main drag there. The other drag on performance is that the technology sector, as I said, under these soft landing hopes, has done better. So it's actually it's returned 7.6%. Our technology sector has not done as well, down 5.5%. But even more importantly, the weight of technology in our market is a lot less. It's only 6% versus 23% for world markets. So the combination of those underperformance of the sector and our lower weight to that sector has been two sources of drag, and that's contributed to about 1% of the underperformance. Offsetting that has been the fact that materials sector has done a lot better. So you can see materials, which is largely the mining sector, up 10%. Globally, materials down 4%. And that's been a contribution to our performance. So just to summarize, I mean, the key drivers of Australian versus global equity performance generally over time are financials, technology, and materials. So if materials are, globally doing well, that supports our performance. If technology globally is doing well, it tends to detract from our performance. And similarly, financials, it just depends whether we're outperforming global banks or not, and whether or not banks globally are outperforming. But I thought that was just I'll try to keep introduce this every now and again. When there were a few months ago, there were major differences. It's actually narrowed a little bit of late, but I just thought that might be an interesting new sort of addition to sort of understanding the relative performance of Australia versus global markets. Moving right along, this is still the biggest issue in global financial markets. So here we have the US unemployment rate still down, actually now down at 3.4%. Wages growth still strong. And again, the soft landing hopes require that this grey line comes down back to where we were prior to the pandemic without this orange line needing to go up. And there's still a raging debate as to whether that will happen. I ultimately don't think it will happen. That's why I think the US is my base case is still that we are going to have a hard landing. The only question is whether or not the Fed has to do a lot of that work, or will the credit tightening that we're seeing going on in the US in the wake of the banking instability does the work. But one way or the other, you probably need to see this unemployment rate head higher to get wages down and therefore get service sector inflation down. Now, just on that one, what we have seen so far, at least, is that job vacancy rates in the US have started to fall. Sorry, I'll go back to here. And as yet, there's been no increase in the unemployment rate. So some are taking some heart from this, in that, so far at least we're having an easing in labour demand. The excess labour demand is narrowing, and so far at least there's been no increase in the unemployment rate. So if we can go back to where we were in 2019, back here, and these are these black dots, then that would be a pretty miraculous outcome, and a potential soft landing for the economy. But tentative signs that is possible. And in fact, Jerome Powell, the Fed chair, himself has said that he thinks a soft landing in the US is possible, even though the Federal Reserve's own staff who do the economic forecasts are forecasting a mild recession later this year. But he thinks, given this sort of evidence, that it is possible. And just to drill down a little bit further into this, here is a chart of median and average wages. So that's average hourly earnings from the payrolls report. Median wages is from a survey, the Atlanta Wage Tracker it's called. The difference between the two is that this allows for compositional shifts. When you get a situation where employment demand is very strong in areas that have below average wages, such as in the hospitality sector or the services sector generally, it can bias down average hourly earnings. And I think that's what we've seen over the past few months. You can see average hourly earnings has fallen, whereas median wages hasn't fallen as much. But if you go back to 2019, for example, here's, we've had a lot of volatility due to the pandemic, but prior to the pandemic, the US unemployment rate was also under 4%, running at 3.5%, and wages growth at that time had picked up, but it was still, reasonable. The Fed in 2019 was cutting interest rates and was happy with the economy, even though the unemployment rate was under 3.5%, and that's because wages growth, as you can see here, was also relatively benign. So it is possible that if the unemployment rate stays where it is, that these numbers can come back down again, because that's what we saw in 2019. But again, at the moment, they are still well above where we are in 2019. In fact, if you look at the median wage number, it's actually ticked up of late. The average hourly earnings number in the payrolls report that came out last week was firm. So at the moment, there's not a lot of evidence that wages growth is decelerating in the way that the soft landing camp would hope. But I just highlight that these are the things we're looking at in debating this soft versus hard landing scenario. And at the moment, the markets are still pricing in, the bond market at least is pricing in aggressive rate cuts. You can debate why. Again, it's either because inflation and wages will fall quickly without a recession, or you'd get that recession. Or the bond market is simply wrong, and they're going to price that out. But at the moment, based on what the markets are pricing in, either the very low level of long-term interest rates relative to short-term interest rates, or the so-called inversion of the yield curve, the probability of a recession based on history is still relatively high. And this is a survey from the New York Federal Reserve, who run a model on recession probabilities based on the inversion of the yield curve. And we are seeing tightening of credit conditions in the US. So this is a survey of loan office, survey of banks around the country, and you can see that it has started to pick up. So there's something like 40% of home lending offices, as they're called, are reporting a tightening of credit conditions. And usually when we get up to around these levels, it has been consistent with recessions in the past. So again, just bears watching. In terms of policy response, so again, as I mentioned, markets are pricing in basically no more Fed rate rises and then aggressive interest rate cuts through this year, and then further into 2024. And you've seen bond yields come down accordingly. I think rate cuts are, look, I think it's possible that you will get rate cuts this year, but you need to see the recession or a plummeting of wage inflation. And I think it's more likely we get a recession than a plummeting in inflation. But again, from an equity market point of view, this gives you no cause for celebration, because if they do end up cutting rates because of a recession, it wouldn't be good news for the equity market. So you can't really count on that. But my base case, for what it's worth, is that the Fed is done. They won't raise rates in June. The market is toying with the possibility of a rate rise in June, but again, given what's happening in the banking sector, they're probably going to hold off for a while. And then I think we will see enough signs of a slowing that they won't need to, but they won't either cut rates. So I've got them on hold this year and then cutting rates next year. In terms of the RBA, you can see it's a bit more of a steadier outlook, at least over the course of the remainder of 2023. Market is not pricing in a rate rise in June, and then fairly steady rates over this year, and then rate cuts next year is what the market's pricing in. Now, the title of our webinar was, will the RBA raise rates again or cut rates? Look, I think there is an ongoing bias. If anything, in the short run, there's a bias to tighten interest rates because growth is still resilient. There are tentative signs of slowing, but again, the RBA surprised me with a rate rise a couple of weeks ago. On the back of, I think, two things: A, the bounce back in the property markets, and B, evidence of sticky service sector inflation globally, and the fear that that might be reflected in sticky service sector inflation in Australia as well. So they didn't want to encourage like a rebound in property prices anytime soon, because ultimately the RBA does want to see consumer spending slow. And a rebound in house prices wouldn't be conducive to that happening. So look, my base case is they won't raise rates again. But if we get animal spirits come back into the housing market, there is a bias that they will raise rates potentially in June and even in July. And as I said, the budget that we've just got doesn't really help. It does help in that regard. If anything, it's going to be a bit more of a stimulus to the economy. The other thing that will give the RBA some pause is that the rebound, we get further fixed rate home loans that are going to be reset at higher rates. Many of you may have already got phone calls from your banks if you took out a fixed rate home loan a few years ago during the COVID when rates were at zero. The official cash rate is at zero, and that the resetting of those fixed rate loans into variable rate or even higher rate fixed rate loans adds another. Basically, it's equivalent over the next 2 years to about 1/3 of the tightening we've seen already. So it adds about 0.7% to the average national mortgage rate. So the average national mortgage rate has gone up about 2% with the Fed rate, RBA rate rises to date. And then just those, as I said, the rolling over of those fixed rate loans adds 0.45 this year and another 0.25 next year to that average home loan rate across the country. So that, in a way, that is further de facto RBA tightening without the RBA needing to raise interest rates. The other thing that gives the RBA some pause is that wages growth, I've said this many times in the past, is still relatively benign, certainly compared to the situation in the US. That could change, but at the moment, the RBA talks up a lot of anecdotes about wages growth rising, and certainly in some areas it is rising, but nationally, according to the wage cost index, it is still rising at only around about 3.5%, which is consistent with inflation coming back down to the target band. So these are the projections from the RBA at the moment. Unemployment basically edging up to about 3.75 from the current 3.5%, and then up to about 4.25 at the end of the next year. So that is a soft landing scenario. A gradual increase in the unemployment rate as the economy slows, and consistent with inflation coming down. So you can see here, even by the end of next year, the RBA still got underlying inflation uncomfortably well above the band. And in fact, it doesn't go back into below the band until 2025. So that's a limit. If the RBA thought that if it revised its projections such that inflation wouldn't be back into the band until 2026, for example, it would probably feel compelled to raise rates and slow the economy, because if it waits too long, as I said, if it waits too long, it fears it could get embedded into inflation expectations. So it's that balancing act that they're dealing with at the moment. As I said, house prices, again, they've bounced back, but I think either they stop rising or the RBA is going to intervene potentially and raise rates. So I think, and as the economy does slow and unemployment gently move higher, prices I think at least will stay flat and maybe drop back a little bit further than what we've already seen. In terms of the investment implications, look, bond yields at risk. I think in the short run, there is a risk that bond yields move a little bit higher, particularly if central banks do end up raising rates one or two more times. But bigger picture, we're at the tail end of the tightening cycle. They won't raise rates anywhere to the degree to which they did over the course of the past year. So bond yields, I think, are sort of sideways to down in terms of the outlook in Australia. And now this is the bigger challenge in terms of the equity market. So this is the US share market. You can see it's as at the end of last week, trading at 18.3 times forward earnings. So all of that rebound in the market on the soft landing hopes that we've had since late last year has been this PE ratio moving from under 16 to back over 18. At the same time, earnings growth has been easing. And again, if we do get a hard landing for the US economy, there is a risk that these earnings numbers will continue to get downgraded. So I do fear a second leg down in the markets as the economy slows, because the valuations are pretty stretched, and earnings at the moment still aren't pricing in a recession. They're pricing in flat earnings growth. So 23, this is the rolling expectation for earnings in 2023 for companies in the S&P 500 index. So they've gone from expecting plus 10% growth in 23 to flat, but then a 10 to 12% bounce back in earnings in 2024. But again, if we do get a slowdown, both of these numbers will get dragged down. The other thing to note is that the equity risk premium, so the market's earnings yield, so the PE ratio inverted gives you the earnings yield. You take away the bond yield, you get this equity risk premium, and that is looking pretty skinny as well. It's down to around 2% versus a 10, 20-year average of 3.5%, 4%. So again, the equity market is counting on interest rates falling without a collapse in earnings, or without a recession or a collapse in earnings. So they are counting on, the only way these make sense is if, again, you do get that soft landing, that quick decline in inflation that allows the Fed to pivot even without the economy going into recession, which again, for the reasons I outlined, it look as possible, and I'm watching those numbers very closely. But at the moment, the reality is that there's not a lot of evidence that US wage inflation is decelerating. And broadly speaking, the services side of the inflation outside of the housing sector does remain sticky. So you need to see the slowdown, or the Fed will act further. And just on the recession, as you can see here, I've said this before, markets have never bottomed before recessions even began. The US is not in recession yet. So the fact that the markets have had a pullback already doesn't mean that they're pricing in a recession. If one does eventuate, history suggests that we may get another leg down and take out those lows. So I think it's still time for a period of caution, but watching the US inflation picture particularly carefully still. Aussie dollar, just to conclude, it's been in this choppy sideways range in the mid 60-cent range. If we do get a soft landing in the US economy, the US dollar will weaken. There'll be risk on sentiment. The US dollar will weaken. The Fed can pivot, and the Aussie dollar can strengthen, potentially up to 80 cents. But if we do get a hard landing for the US economy, which again is my base case, is probably going to weaken down towards 60 cents, may even break under 60 cents in that scenario. So I'd be, again, along with the equity market, still pretty cautious about the Aussie dollar at the moment. That's pretty much it, I think. I'm happy to leave it there and open it up for questions.
Excellent. Thank you so much, David. Now, look, there was a number of questions sent through for the webinar, so we'll try and get through as many as possible. Look, I think a lot of the questions is really on the basis that a lot of people here today are of the view that there is an impending US recession. The first one, just from an asset allocation view, there's a question here asking us, given we run our own managed account portfolios, what are we doing based on the basis of what you've covered today in terms of our asset allocation?
Yeah, so our model portfolios have diversified exposure across cash, global equities, Australian equities, bonds, Australian and global bonds, some opportunity to also add gold. So, and we basically invest in a variety of low-cost exchange-traded funds, many of which are ours. Not all of those are our ETFs, so that's the managed accounts that we run. And we do a dynamic asset allocation over the top of that. So a balanced portfolio, for example, would be 50%. A strategic allocation in a balanced portfolio would be 50% defensive assets, cash and bonds, and 50% equities, global and Australian equities. At the moment, we are defensively positioned out of the risk of a hard landing in the US. And so we have an underweight to equities, moderate underweight to equities. And now when you're underweight equities, you can put it in either cash or bonds. Where do you put it in the defensive assets? And at the moment, we are overweight bonds. If we thought bonds and equities would sell off, we would be, putting that in cash. But at the moment, we think, yes, there's a risk of a hard landing in the US. It's not priced into the equity markets, but most of the tightening we're likely to see from central banks is probably behind us. So bond yields look attractive, particularly if we do get that slowdown sometime soon. So that's how we're positioning at the moment. We don't have a lot of tactical tilts in terms of Australian versus global equities, Australian versus global bonds. We're pretty neutral on that front at the moment. But when we get into another type of market environment, we'll certainly reassess that. When we get into maybe a bull market environment, depending whether it's a commodity boom or a technology type boom, that will influence our positioning in Australian versus global equity markets.
Excellent. And there's another question just in relation on the backdrop of a US recession is what would the positioning be versus, say, a corporate bond ETF or a government bond ETF if that was the scenario that plays out?
Yeah, so in an economic downturn, credit spreads usually, so when equity markets weaken, credit spreads widen. The risk on owning private sector, private companies, credit exposure to private companies is higher than it would be on governments, because governments don't go, at least Australian government and the US government isn't going to go broke, whereas there's a risk that to corporations that they may go broke during a recession or a downturn. So what we see is corporate spreads widen. So for a given duration of a bond, corporate bonds will underperform government bonds. So of the choice, if you feared a hard landing, you would be overweight Australian bonds. So in the case of our ETFs, for example, AGVT is a bond that tracks Australian government bonds. CRED is an ETF that we have which tracks corporate bonds, but longer duration corporate bonds as well. But again, but if you had to choose, between corporate or government bonds, the preference at the moment from a tactical point of view would probably be government bonds.
Excellent. And what's your view, I guess, in terms of gold in recessionary times?
Gold, yes. So we do have a gold ETF that gives you exposure to gold bullion in US dollars. It's a tricky one, to be honest, for gold, because what we saw during COVID is that gold briefly went up when we get a recession. So basically, I think there's some countervailing forces. If you get a recession, bond yields fall, central banks start cutting interest rates, which is positive for gold. When interest rates fall, the opportunity cost of holding gold is reduced. But I actually think in a recession, the US dollar may go up because that becomes a safe haven type trade. And a stronger US dollar is negative for gold. And the other thing that in terms of underlying demand for gold, for jewelry and these sort of industrial purposes, that demand falls in a recession as well. So that can help undermine the price of gold. So I'm not completely convinced that gold is going to rally strongly in a recession. I think it may, probably in fact weaken. The environment in which gold does well is if central banks gave up on their inflation targets. If we had high inflation and central banks said, you know what, we're going to tolerate high inflation, we're going to keep rates low because we don't want to jeopardize economic growth. Now, if they had said that over the last couple of years, gold would have done a lot better. But they didn't. They were hawkish, and so gold, it's done okay. Gold's actually outperformed bonds over the last, during the bond sell-off. Yeah, I think inflation's coming down, and I think a hard landing is probably not super positive for gold. So again, in our managed accounts, we can invest in gold, but at the moment we don't have any exposure to gold.
Excellent. Thank you. This is probably a good question that came through around, I guess, the debate versus quality versus value as a factor and what's better positioned in 2023. Obviously, you covered that new chart around sector and relative performance versus Australia versus global in terms of the sectors, which tends to sort of, fit into those two different styles or factors of quality and value. To that question, what's your sort of view of which factor, again, past performance is an indicator of future, but with the sort of implications of what you've covered today around possible recessions, which one of those would tend to fare better in those type of economic circumstances?
Yeah, so quality. So what is quality? Quality are companies with above average return on equity, good profitability, not a lot of leverage, dependable earnings. So we have a quality ETF, QLTY, that invests in the top 150 companies around the world with good return on equity and not a lot of leverage. And that tends to do well in a downturn historically. Now, quality as a factor actually sold off last year. It underperformed when interest rates were rising. So unusually, from an historical point of view, it did sell off last year when interest rates rose and equity markets fell because of the rising rates and the fact that a lot of quality companies today tend to have a tech exposure as well. And so technology got sold off, and I think quality got caught up in that sell-off last year. But it has bounced back with the of late with the easing back of bond yields. And I think in a recessionary environment where bond yields are falling, not rising, quality will probably hold up okay, well, relatively speaking at least. Whereas value, and what is value? These are companies, typically companies like energy companies and financial companies that have a below average PE ratio. So just for, if you don't know, basically the value, you might have heard the terms value versus growth. Basically, the way that you take all the companies in a given index, you rank them by their PE ratio. Those in the top 50% by PE ratio are called growth, and those in the bottom 50% are called value. Now, if you look at the sectors that typically are in each of those, typically energy companies and financial companies have lower PE ratios, so they're in the value camp, and the technology, to some extent, quality type companies, but by industry sector at least, certainly technology tends to be in the growth camp. Now, in a recession, financials tend to not do well because falling bond yields crimp their profit margins and credit growth slows. And energy companies, if energy prices come off, also don't tend to do too well. So I actually think value would underperform in a harder landing. So long answer, but just to explain why all those rationales is that quality should, my expectation would be quality would outperform value in a US hard landing scenario.
Excellent. An interesting one here, a bit of an economic measure. Can you please explain how shift share figures work?
Yeah, I put that in there, but so shift share is basically if you think about the Australian versus global equity market. If we've underperformed the global equity market, there's two reasons why that could happen. Firstly, we could be overexposed to sectors of the market which are not doing that well by global standards. So, for example, if financials, if globally the financial sector is underperforming, like not doing as well as the global markets, and we have a big exposure to the financial sector, then even if our financial companies did as well as the global financial companies, it's going to be a drag on our performance because there's a higher weight to those underperforming sectors. So that's what's called a negative industry effect. And by the same token, if a sector is doing very well globally, such as technology in the last few months, and we have a low weight to that sector, then that's a drag on our performance as well. And so so that's an industry sector effect. So typically when there's a commodity boom, for example, the industry sector effect works in our favor because we're overweight the commodity sector, which is doing well. And when you're in a tech boom, the industry effect is a negative because we're underweight tech companies which are doing well. So that's one element. The second element is that our sector, a given sector in Australia is underperforming relative to a global sector. So our bank's not doing as well as global banks, and that's called a competitive effect. So that's shift share. So it basically decomposes the difference in performance from one market to another into industry effects and competitive effects. And just to summarise, as I said, in that modest, the period that we have underperformed is because, firstly, a competitive effect. Our banking sector has not done as well as global banks because falling interest rates tends to benefit global banks a bit better. Because it's more beneficial to their net interest margins, whereas and also the other effect has been that the technology sector has done well, and we're underweight technology. Now, offsetting that, at least partly offsetting that, has been the fact that our mining sector, which is in the materials sector, our mining sector has done relatively well. So that's the shift share. So what a very astute question, because those tables I showed you was actually a shift share analysis of the difference between the Australian and global equity market performance.
Excellent. I think we've got time for one more here, and it's just around the possible economic impact of China invading Taiwan.
Oh, I shouldn't laugh, should I? But I mean, who would have thought Russia would invade Ukraine? I mean, such a crazy thing that never say never. Look, what the economic impact would be, I mean, look, it's hard to, it really depends on, look, it's very, I mean, obviously it wouldn't be a positive for the global market. So, if they invaded quickly and did the job very quickly and the US didn't intervene, as harsh as it may sound, that the global economy may shrug and move on. A bit like, look what happened in Hong Kong. They basically, effectively took over Hong Kong again. There were a lot of demonstrations in the streets and whatnot, but the economy, the global economy, basically looked the other way. So if China miraculously, invaded and it was very clean and they took over quickly, it was all over Red Rover, then the impact wouldn't be that devastating. And I think, there might be some sanctions on China. But ultimately, I think, the real politic of the situation would be that, people might look the other way. Now, if it's messy and it's a protracted engagement, a bit like what we're seeing in Ukraine, and the US was sort of, US wouldn't directly intervene because it'd basically be World War III, but they might, indirectly provide a lot of armaments and, help, to the maximum extent they could. Then you might get sanctions being imposed on China. You might get a slowdown in global growth, a lot of, disruption, instability, uncertainty. Aussie dollar would sink like a stone, quite clearly, and that will have a more, obviously negative impact on growth. Look, I ultimately don't think China will. I mean, and again, I'm not. From what I understand, it's actually not that easy to think that China can invade. They've got to, cross water. They've got to land boats. They can send paratroopers in, but they're pretty well, pretty well prepared. Taiwan to they've been planning for this for years. So I don't think it's a walk in the park for China to think that it can take over that country. And Russia, and if anything, Russia provides that reminder. So you never say never, but that's the way I'm sort of been thinking about it.
Excellent. Well, again, thank you so much, David, for going through our quarterly webinar update. Thank you all for attending today. And as I mentioned earlier, the recording of this will be sent out tomorrow.
Bye for now, and best of luck out there.